Have Wall Street set the trap for us as retail investors? In our last video, we discussed the idea that markets were not paying attention to yields. All of a sudden, that's flipped the switch. And as we know, it all comes back down to large transactions going through the market. In today's video, we take a look at the biggest dark pools that have appeared over the last 48 hours and why we need to be paying attention to them, whether we're traders or investors. And we look for the opportunities around the world. There might be some bad charts, but there also are some very exciting ones. Let's cover stocks, commodities, and cryptos right now together. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss because, of course, as always, there's some big macro news, leading indicators, and we're taking a look at the hottest charts and the opportunities for us right now. But let's get stuck into it straight away with one of our favorite investment asset classes and the data surrounding whether this is a turning point for gold. As you may know, if you've been watching the channel for over a year, you would know that we love gold and we believe that it could get to $3,000 an ounce over the next 12 months. So with this pullback in mind, is it a buy at these points? Well, let's take a look at the data and see what it suggests. Firstly, the 20 weekly moving average. We've just hit it on gold and we know that this is what we call mean reversion. A pretty good level, and we'll look at that later on the charts. But what about this zone here? What we've just seen recently, which is that the market has sold off below its 50-day moving average and then sold a further 2%. Well, as it turns out, every time it's done that during 2024 so far, it's been a buy the dip from central bankers. And as we know, it's really all about the central bankers and their purchasing of gold throughout 2024 that's allowed it to go up so much. More on that coming up later on today's show, but let's talk about sentiment because, of course, we know everybody was FOMOing all over the place after the US election. And it looks like the results are in for sentiment surveys and they show the same thing. Almost 50% of people are now ultra bullish over the next 6 months. Everyone is not confused anymore with a very low reading in terms of neutrality. And of course, the bears are basically about the same. Now, why is this important? Well, it's that really low neutral reading, which means that there is a polarized side right now. A lot of people bought in, and Wall Street loves to knock, of course, retail traders out and trap them. I'd like to think that we're not trapped at this stage as a community, and that's because, of course, we've been reading these charts, the data, and we understand also what's most likely to come. So we'll go through that in just a moment. But are we at a tipping point when it comes to bonds? Yes, it looks like 10-year treasuries for the first time in a little while have been going back above SP500 earnings yields. And you'll remember this is something we saw a lot of back in 2023 and, of course, the beginning of 24. It's been a little while since we've actually moved back here. But it just shows you that the US economy is actually quite strong underneath, but has the Fed done enough to stop inflation? Well, about 24 hours ago, we found out the inflation report numbers, and it showed us that the CPI was up to 2.6%. Now, that may be in line with expectations across the board, but as we've been talking about, we're following a very similar narrative here to the 1970s. And it's very important that all of us as traders and investors pay close attention to how this CPI number continues to fare, especially if we see tariffs in 2025. Now, this is about a 1-month-old chart, but we shared it over on X. And if you're interested, go and get that one by following FX Evolution in the description down below. And you'll notice that what it's actually done is it's done this so far. So it's dropped a little bit more, and then we've seen it go back to 2.6% with a small uptick. Now, is this the exact same overlay that we saw in the 1970s? Well, it's something we need to be paying attention to because, of course, what happened there was we saw inflation rise back up, then it went stagnant for a while, and we saw an absolutely ballistic run. Now, that's not to say that we're going to go into the same period, but remember, history does rhyme sometimes. And of course, in this case, it could be one of the concerns that we haven't seen Wall Street really say, oh yeah, that's a problem, let's sell the market off from that. Would we go against the market right now? Absolutely not, but keep this one in mind into 2025. Now, what are the good signals right now? Well, as most of you know, the American consumer, which you can track by putting in the code XLY versus XLP into your trading platform, is very important to the market. If everybody has a little bit of spare cash, they're able to buy stuff, and that overall creates, of course, growth in the economy and GDP increasing. In this case, you might think, well, everything's terrible and no one has any money, And it seems like that's not the case. I mean, have we got as much money as we did in 2021, 2022 free? Well, the answer is quite simply no. But it still looks like overall savings deposit balances are still above their 2019 level. And this bodes well for the general retail sales moving forward. And we're also noticing that credit card spends are still moving up month on month on month. And although you might be saying, well, this is all going to end badly, and maybe it will, at this stage, it still looks like people are willing to spend their money, whether they have it or not. What about forward earnings? Now, a lot of people are worrying about this chart. A few people in the comment section saying I'm not buying anything because it's 22 times earnings and there's no way that I'm buying into a market like this. Well, we've got to remember the Mag 7 obviously distorts this figure a little bit. I think if you actually pluck the top 7 stocks out of the SP 500, you'll get back into about an 18 or 19 PE forward, which is about normal. As we know, 16.4 is the actual 25-year average. But we certainly are entering into the danger zone. And this has had many people like Warren Buffett, as we've discussed, putting in a lot of cash over the last 6 months in particular. And we'll look at that right now just to show you that what Buffett does may not instantly translate into actual profits. We've actually tracked Bank of America, and you'll see what we mean in a moment. A tax cut to 15% is what the market is starting to price in, and that's got consumer discretionary being the best sector of the last month. And you'll see here the EPS benefit is expected to be 6.8%. So there is reason why this market is going up. And of course, most economists right now are going bonkers on their calls. Now, we've talked about 6,200 over the next 3 months to 6,300. We've obviously discussed our kind of topic of possibly seeing a 68 to 6,900 by the time this bull run ends. And you may disagree with that and say, oh, that's ridiculous. But it's kind of in line with how things are. So when you see crazy handles like 7,000, don't be surprised if even that gets wilder into 2025, especially if the markets can recover and continue to go up. So where are the best sectors? Well, of course, the small caps have been in focus, especially post-US election. Everyone really going into those regional banks and thinking, doesn't this look great? But now with the Federal Reserve potentially saying, hey, we're not going to maybe cut in December. Remember, it was a 75% chance that we'd get a cut into December. And now Jerome Powell's like, oh, maybe the economy's a little bit too strong. Will we still see playing catch up here from the small caps? Well, it's my belief that we probably will. And you've got to remember the reason why is because pretty much since 2021, 22, when we saw these decouple, we've never gone back to the normal standardized kind of market where we see small caps and mid caps getting priced in at around the same level as the S&P 500. Eventually, things all usually go back to some form of mean, and I guess we need to keep that in the back of our minds. But is there a bad stat? Well, unfortunately, there's a good stat and a bad stat. There's the gap up stat, which happened straight after the US election for the Russell 2000. And I always like to share with you guys the good, the bad, and the ugly. So here is the ugly, and that is that when the Russell 2000, after 3 consecutive days with over a 0.5 loss following a 3-year high, because remember, of course, the Russell was absolutely blitzing it the other day, it is not very good. 1 week later, actually, only 33% of the time was the market up. Now, we don't have too many reads for this, but it does have a lot of people concerned. And of course, the big one here is look at the 3-month stat in particular. 0% of the time was it bullish over 3 months. Now, that's completely different to the other stats we've seen. So it's going to be very important to see how the Russell 2000 acts around these pullbacks. Do we actually see buying in, or is it continuous selling? And of course, we'll talk about our opinions on that right now. First up, you usually do see a post-election pump, and we've already had that, but we usually go through all the way to the inauguration, with pullbacks being met by bull demand. Now, it's at this point that we still have to believe that overall the markets are bullish. And although we have one data stat saying, whoa, wait a second, on the Russell 2000, we do need to remember that whether you go to 2012, 2016, 2020, or now in 2024, we still have pumps that occur after the elections themselves. And specifically, they usually affect the best, the Russell 2000. We also have some 100% stats towards overall bullishness. No recession, check mark. Strong structure coming into the overall US election, check mark. When we have those types of reads since the 1900s, we have a very strong market for the next 3 months. So we have to look at these pullbacks to be Wall Street most likely trapping retail traders at the highs and squeezing them for all they're worth. And I'm hoping that most of us out there are not getting trapped in those 6,000 levels on the S&P 500 with some random leverage. Now, I said before that Warren Buffett tends to make big calls and they tend to be early. We've already shared this chart, so we won't go into it too much, but $300+ billion of overall money, of course, kept in the fund now. Over 25% of the overall asset class is now cash, which is incredibly unusual for Buffett. But we need to remember that he's not an exact timer. So, there are charts like this where Bank of America has been sold by, of course, Buffett recently. And you can see here that he's sold it at points and the market has continued to go up. Now, possibly the most famous sell this year was, of course, Apple. Has it returned very strongly after that? Yes. So remember, Buffett's timeline is always very different to us, the retail traders and investors. And you do need to keep this in the back of your mind, just like that 1970s overlay, for things to look out for. Remember, you have to have optimism in markets, but at the same time, you need a healthy level of skepticism when you're looking at the correct things. And one of the correct things that we've been talking about is these squiggly lines. We like to overlay different market conditions to see whether something is performing normally or not. And you may notice, since we're looking at 2022 to now, we are smack bang in the middle of an incredibly normal bull market. And you may say, well, this is different this time, etc., etc., etc. This is a lot of data read. So it's not just one data read. And what it suggests is that we should be going stronger into 2025. And as I've said many times, there is a higher chance of a 10% pullback happening in 2025 than 2024. We mentioned this several times. Obviously, August, we got that significant pullback. We looked to buy the dip there. It was a pretty good move. So congrats to you guys. And at this stage, we're still quite bullish on market structure. So whatever pullbacks we're seeing, we've got to think that they're bullish. And there are so many reasons. Post-election pumps in Russell 2000, post-election pumps in Bitcoin and the crypto markets. So far, Bitcoin has been going ballistic since we've talked about this. And of course, it topped off well above 90K plus. But we have started to see Wall Street placing a couple of large orders. It looks like they've taken a little bit of profit. So let's talk about this. First up, Coin. I noticed a few people were taking some clips off Coin over the last 24 to 48 hours after seeing this big read. And that is the third largest transaction ever recorded on Coinbase. Yes, it probably was a sell because we know that we had a monster dark pool transaction down here earlier, and that led into a lot of people liking this particular stock. Remember, we were loving crypto post-September for so many good stat reasons. September was positive. October, November, and December tend to be positive with those reads. Post-election pump, everything else, it's played out very well. And I would like to give you guys a clap because you've done very nicely on that one. I see a lot of people commenting on how well their portfolios have been going. Congratulations. But what about MSTR? This thing is disconnected. Now, I may be wrong, so someone in the comments down below tell me exactly what MSTR's Bitcoin is being priced at. But I heard it was like 250,000 a coin. Either way, it's run incredibly quickly, and I would say this is a squeeze. So effectively, it squeezed out short sellers, and it looks like someone went, you know what? Nice profit, totally disconnected from price. I'm getting out of it. You can see the large trades over here. The second largest transaction ever to go through on MSTR. That's a big one. And since then, of course, a little bit of a drop off. This reminds me of a blow off. And basically that means that we're probably topped out in this particular stock for now. Now, could it go higher? Sure. But whenever you see these types of things, it doesn't bode well generally for that instrument for about the next 2 to 3 months. It's something similar we saw actually in China markets, which we'll be talking about very soon, only just recently. And guess what? They haven't performed very well, have they, since that point? Tesla bull shares, you can see here we had a bunch of transactions going through at the highs. This is a 2x leveraged fund. So of course, Tesla has kind of suffered, I guess, a little bit from that point. And we just got another large transaction coming through. This is for BitU, ProShares Ultra Bitcoin ETF, the largest transaction ever, a dark pool. Huge stuff, guys, right at the peak. Is that telling you that someone's probably taking a bit of profit? Possibly. If you're hodling over the next couple of months, should you be concerned? Probably not, because of course the data is very good. And we've already discussed the idea that at least in our belief, based on some of our assumptions and some of the things we've looked at in previous cycles, we still think Bitcoin can get to 120, 130K over the next 12 months. But yeah, maybe temporarily it's hit a high for now. Now, we saw Disney come out with a pretty good result and go ballistic. It actually was showing better overall structure a little while ago. And of course, now we have Baba on Friday. And as you guys know, this has been about China this week. And what's happened? It's smashed into the 61.8 golden fib pocket. And this is a very important point. But before we go through that, let's get into the flows for the SP 500. So you've probably seen a bunch of these charts before, people with this stupid trend line above saying, oh, yes, see, we hit the trend line, we're going to sell off. Yeah, sure, that's for sure. I mean, it's a level you could definitely mark out. But we knew that 6K was also a massive call wall. Whether it was this week's 0TT options or it was the next month or the next 3 weeks or any of those periods of time, we were continuing to see this be a very strong resistance. And what it's marking is probably a pullback back down into, hopefully, the daily 20 moving average. Now, at the time of recording, we're getting closer and closer to this point. But remember, we've started to kind of stuff this level with a few things. And that's in particular things like, of course, the options low level today. You'll notice 59.07 is the options low level. The 38.2 fib seems to be around there. Popular swing Fibonacci in those types of things. And of course, previous market resistance at around the same level, plus a little bit of demand structure. But what about the options market? Probably the most important right now for all of us when it comes to seeing these key supports. Well, as we suspected, take a look at this, guys. We seem to be having quite a lot of calls and puts at certain levels. Now, the amount of calls coming through 59.50 has gone ballistic. It's unlikely we're going to reclaim that straight away, but have a look here at the put walls. 5,900, check mark. This is for, of course, next week, Monday, and 58.50, check mark. Big put walls. People are starting to commit to trying to go short on this market in a big way, and that's all happening next week. So, of course, we're starting to see that come through. At the moment, there is a huge transaction at 59.50, and the market may try to hold below that into the Friday trade. Now, why is it important? Well, it isn't really. I mean, a pullback is just normal. This is what we have to expect after such a huge rally. But yeah, if it gets above 59.50, what does that enter? Positive gamma again. So just remember, it's these options, call walls, and put walls that do matter. We are, of course, connecting them with the technical analysis, the demand zones, the structure, all of these types of indicators. And at this stage, it looks like 58.50, 5900, around that area should be where we start to see buyers recommit to the markets. What about Nvidia? Well, as we've always said, it's struggling around 148, 150. Nothing changes, gets above those, positive gamma ensues. And then, of course, Tesla. Well, where is the put wall? Where are we actually going to see buying come through? If you might, let's see if we can pause the video here, put it in the comments down below. Do you see where it should be? Yep, if you were correct and you put 300, you'd be absolutely right. 300 seems to be the put wall. So we're trading at about 311. We're getting very close to that psychological level right now. And 305, 300 seems to be the biggest strike over the next coming weeks when it comes to Tesla positions. So we may be right on or very close to where we're going to see buying pressure. Now, you may notice a bit of a theme here. We're seeing the S&P very close. We're seeing Tesla very close. Obviously, Nvidia, well, it's doing its own thing because it's a great stock. But they are starting to synchronize together into a very key level. Could it go lower? Of course. Do we see a reaction here yet? No. But certainly, it's interesting to pay attention to. So just before we jump into the charts and we take a look at all of the key levels we need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is obviously Tiger Brokers. Now, if you're not aware, Tiger Brokers are offering you guys special deals down below, especially for the Australian viewers out there. All of these extra bonuses if you sign up and deposit $2,000 with the T's and C's, of course. But I also want to give Tiger Brokers a bit of a shout out. They've just celebrated their 10th anniversary. They actually sent me a little box to say thank you for obviously covering their stuff. But at the same time, I want to say what that really means is they've been around for a while now. That's good. They're trustworthy. Obviously, they're winning a ton of awards. And I think that's the big deal. But for Australians out there, the biggest thing of all is 24/5 trading. If you want to trade US stocks, if you want to trade Hong Kong stocks, possibly you may want to do that now because of course China's coming back down. Check them out. They're offering overnight trading hours And this is just getting so exciting for day traders and investors to be able to invest in the greatest markets in the world outside of Australia or outside of the country that you're in. Because remember, tiger brokers are everywhere. Then you can maybe start to think about doing this. So why not check them out today? Very cheap in terms of the brokerage, some extra specials for you. Links in the description down below. Check them out, guys. Okay, let's break down the charts and look at the lead indicators. A few of you have been screaming at me, please, Tom, bring back the central bank liquidity. What's going on with these central bankers? Well, you would be correct that they're actually trashing liquidity right now, whether it's the world central banks or it's even the Federal Reserve. And this is surprising to a lot of people when I look at it. In fact, this could be boding kind of poorly for crypto over the next coming weeks. And although I'm not going to, of course, look towards selling crypto or anything, central bank liquidity is dropping. And I think we're going to need to pay a lot of attention to this into 2025. It's unusual to see both dropping across the board, especially when markets have been quite strong. What about the American consumer, XLY versus XLP? Well, obviously this is being helped up by Tesla, but at the same time, no matter which read I look at this, it's going pretty well. So of course, the American consumer, based on our charts before, especially about household income and household savings, still looks pretty good. The US 10-year is certainly a concern. We're putting pressure on the top side here, and that is directly affecting treasuries. And I've been looking for you guys to see whether we're getting large transactions in. There's a couple of big ones. I think we just got the 90th largest transaction around this price, but we're not seeing that big kahuna, the huge, big dark pool Wall Street bull that's really buying back into treasuries. So for now, it looks like we're just waiting for price action to commit with a large transaction. And remember, that's this daily 20 moving average as well that you'll want to be paying attention to, and the bull zone that we've marked out here. Few large trades. We're not necessarily knowing that they're buys yet though. So the US 10Y and TLT, there's something happening there though, guys, and we need to pay attention to it. Now, what about copper in the metals market? Well, we just saw a big switch. Could we be seeing a star pattern formation? A sell, a doji, and a buy strength. Wow. Things are really turning here in the metals market, and we're at an incredibly important zone. In fact, a marked out level for copper after it getting destroyed also marks in well with Chinese stocks. We'll take a look at those in a moment, but let's go over to all of the major kind of synergies here. First up, US dollar, the highest point we've been at for years. Take a look at this. The last time we were here was October 2023, and we've just smashed in to this key level. Is this a resistance point for dollar? You'd have to think it's at least going to take a pause around this area. So dollar at resistance, obviously we're going to watch this level very closely. Let's move over to gold. Now, you guys know I love gold, and I was expecting a pullback, maybe not this deep. I probably thought it might go to 2650, but I've got no problems with it coming down to this level. Now, you might say, why would you have no problems? It's dropped like 7-8%. Because this is the way market is. Markets have to, of course, trap in people. And I do know that this is a point of usual seasonal weakness for gold when you look at the bull cycle overall so far. I actually shared that chart in our private community. If you're ever interested in checking it out, then join us up for the free 7-day trial. Links in the description down below. So overall, here you can see gold is coming into a very important zone. I've marked it as the second bull zone. I found quite a lot of confluence there. And again, it's managed to buy back up over the last 24 hours. Now, that's an important first read for gold, but I might actually look at silver when it comes to the better structure. Let's take a look at silver. A beautiful downward, or this trend line down here, getting hit and then bounce back off. Now, we talked about silver in our previous video, and we said we like this zone. I do like this zone, and I want it to breach this downward trend line. Take a look at this. The whole way down, it's been sell. Do we breach it and breach 3120? If that happens, could it be go time on metals? Certainly could be. And of course, that's from a technical analysis base. So just remember, there are other things going on here in terms of confluence. A very critical point, though, for silver and gold and copper, and they're all holding. And you'll notice that China also came in at the exact same time. For oil, it seems to have struggled around 69.20 a barrel, which obviously is where we think that resistance is. For now, it's still confusing, but if I had to argue, I'd say it's possibly more bullish on the small time frame action. So at this stage, oil is trying to commit itself at this point. What about Tesla? Well, I think we know that 300 is the major put market. So that's where we've got basically all those puts, 305, 300. And that just so happens to be where we've got those previous resistances. So it's what we call role reversal. And again, Tesla taking a bit of a breather like the rest of the market. A very important point coming up. Nvidia, nothing to report. Literally doing well, holding like a boss. The stock is pretty damn good. Now let's move over to China. Now China came down to a very critical level, the 61.8 fib. Everything's been selling. We've been waiting for this level for a little while. And of course, boom, there we find it. So this is pretty important. Chinese stocks obviously getting smashed into the earnings, and it looks like we're starting to see a little bid coming off this point. Now, is this enough? We always say buy the V, don't buy the dip, which means if you buy on this side, you usually do worse than buying on this side, because this side you're getting confirmation that you were correct. This side you're just kind of guessing. And as I say, patience, react, don't predict is usually a bit better. But yeah, it's come down. We were patient. We waited for these levels. And I think anything between this level and this level should find some buyers. We do not have dark pool liquidity coming through. We do not have large transactions coming through. But what a critical level along with gold, copper, and pretty much every metal across the board. Let's now move over to the US markets and take a look at the US 2K. It's getting very close to that daily 20 moving average that we talked about and 2300, 2320. So this is a pretty decent pullback. It's what you would usually expect. Of course, it's a concern on yields. And if we go as low as a 61.8 fib, that's also going to mark in with those previous highs. So is the Russell 2000 a buy here? Well, we haven't seen a bid, so obviously we don't know that. But from the data perspective, there is one really terrible data report that we obviously put through today, which is showing a possible high for now. And then there are the synergies with the post-election pump, which obviously we've been talking about in terms of market structure. A lot of it is also going to come back to that US 10Y. If it breaks to the upside and we keep seeing yields going up, it just doesn't bode well for small caps. So a little bit to watch here. I guess from my opinion, we're still looking, generally speaking, bullish when it comes to the US 2000, though. I think overall it's still better than it is bad. Nasdaq pulling down to exactly where you would suspect. We already marked this one out. Obviously, a breach underneath 2100 really kind of marked out to us. It was going to 20,800. And it just so happens that's where we're at this stage. Again, should we be worried about the Nasdaq? Probably not. This is just what you have to expect. It traps people at the highs, and then it likes to do things to make people look pretty stupid. And unfortunately, for many people, they will be trapped in at the highs and probably leveraged up there, getting hit out. The same type of things happening in the crypto markets at this stage. Someone went really bullish on massive leverage. Well, guess what? They're going to get hurt. Now, we can see here that it's kind of made the distance that you would expect around this 38.2 fib. They're all kind of synergizing together. Will we see that more important 5,900, 58.80 on the S&P hold? That's probably the most important chart to be looking at. Ethereum also lost some ground after going ballistic this week. Again, wouldn't be too concerned about it. You have to expect it was our first TP zone. In a healthy market, it goes up, usually 2 steps forward, 1 step back, 2 steps forward ideally. So no cause for alarm just yet, but MSTR in particular was getting a lot of transactions. And remember, if you look at coin since we reported that large transaction, you can see here again, filling the gaps to the downside. I mean, they just went so ballistic. It's just how it is. Now let's move over to Bitcoin. Still looking pretty good, still holding up nicely on the weekly, but of course below its last level. Now, whenever I get these types of stop signs, I always say, well, let's just chill for a little bit here. You'll notice that previously when we've seen it, it has been either tops of markets or sideways periods. My thought process is a little bit of a pullback in time, which basically is a sideways, digest the move, burn some time, and then move towards the next direction. So that's where I think we're at with crypto for now. Pullbacks, will they be met by bull demand? Certainly could be. Could we go as low as 80,000? It's certainly possible. As you can see here, catch up on the daily 20 and some of our VWAPs could be pretty sweet. And obviously we'll be paying attention to that. In terms of news moving forward, the retail sales is the most important. In terms of Jerome Powell's comments about whether we're going to get a rate cut or not, don't worry about it. I think it's irrelevant. And obviously they're just going to do whatever it takes. So don't worry too much about the Fed. We can ignore them for now. And of course, the CPI and PPI numbers are worthwhile continuing to track into 2025, but not being freaked out about. If you enjoyed today's video, then make sure to check out our stuff. Our Black Friday sale has just started as well. So check out our courses if you want to learn more about replication or our community. And obviously, we'd like to give a big shout out to Tiger Brokers, who is the sponsor of today's video. It does help us make these, of course, daily shows and give the free content to you guys. So check them out, especially if you're from Australia. Some extra specials for you guys down below in the pinned comments. Thanks so much, guys. You have a fantastic day. We'll see you in the next one. Bye for now.